Good morning. Hope you're having a nice day so far. Looks like up here in Maryland, we're going to have some pretty good weather today, finally. It's going to be in the low 70s and sunny, so it's kind of nice. Welcome to another episode of Coffee with Kirk. And what I'm going to try to do today is sort of set the stage for maybe a couple weeks to talk about what's the end game, what's the longer term outcome for the markets. Obviously your investments are probably the biggest thing. Well, absolutely nobody knows. I've just been reading a lot, watching a lot of videos, studying, and trying to get a feel for where does this thing really head. Now, the timing is always the tough part, of course, but looking at what's been going on, really the past few decades, what's the end result going to be? What's it going to look like? So today we're going to start by just looking at a few of the biggest trends that I think are going to have an enormous impact on us going forward. So let me fire up my presentation here. If I can find it. Where did it go? Okay. So I titled this presentation, The Four Horsemen of the Apocalypse. I'm not claiming there's going to be an apocalypse or anything like that. It's just thought it was funny. But there's four things that are going to have a massive impact on the entire economic environment. This was a little slide I saw. I thought was pretty good. I've seen other things, little memes out there in the internet, saying, January, everybody thought this was good. 2020 is going to be my year. By April, you're using used socks for toilet paper, but this was pretty good. This is probably a good idea. Come in January, really optimistic, and here we are in May, and you feel like that last picture there. But anyway, again, the Four Horsemen, we're looking at four trends that have been developing, and these have been developing for decades. It's not something that's just turned on right away, but they're going to have a material impact going forward on just life in general and the economic environment. And it's, while a million things can happen in between though, as this progresses, but these trends are going to influence us because they're going to have to. And ultimately the end game is deflation versus inflation. Those are like the two negatives that you always have with the economy. So you're always kind of fighting inflation and deflation. The Federal Reserve has a mandate to get 2% inflation. That's what they want. They want inflation, but they want controlled inflation, right? Everybody wants the Goldilocks scenario, and they try to avoid the outers of that. But the problem is with some of the dislocations that the Four Horsemen are presenting, there's going to be issues. And the question is it going to be deflation, which you could say is sort of like a Great Depression kind of era, where everything was deflating in mass and massively deflating, or is it going to be inflation? So are we going to see kind of the 70s returns, something like that, maybe even worse? And what's the eventual outcome for just the economic structure overall? The big thing being the dollar. So there's a lot of things at play here. So the first horseman that I've already talked about this in the Coffee with Kirks a couple of times. This is kind of the first horseman that's going to have a big impact. And it's just been that the stock market before this crash or before the downturn, it was just at historically high valuations. And in fact, it was reaching points that the only other time we'd eclipsed it was 2000. So we even had many valuations were higher than they were back in 1929 for the Great Depression. So again, valuations don't tell you what the market's going to do day to day, month to month, year to year. But it does give you a longer term trend, maybe that 7 to 10 year period. It gives you an idea of what's going to happen. If you go back to 2000, and from that point, really up until, let's say, I guess it was probably 2013, you had a flat market. You had a market that hit the peak at 2000 and just carried over to 2013. So you had a 13-year period where the market was flat, excluding dividends. So valuations kind of give you a longer term trend. And we're back to that point where, it was a 13-year trend from 2000. If the 2000 valuations produce a 13-year sideways market, if we're already back to those levels before this downturn, what's that imply for the future? And it's not going to be great valuations. And it didn't matter what metric you're looking at, honestly. This looked at a couple price to sales. You take the S&P 500, compare it to the sales. It took the enterprise value divided by earnings before interest, taxes, depreciation. So basically the value of the company divided by its earnings. Everything there was hitting highs. These are a few other valuations, and I've shown these slides before, but we're basically in the top 94 percentile at a minimum as far as historical values for different things. Most of them were in the top 2 or 3% of all-time historical values. So it's, you're just looking at kind of a situation where the market has some serious headwinds for future returns. This is looking at Robert Shiller's CAPE index, cyclically adjusted price to earnings. And you can kind of see that red line at 30. Once you get past that, you're looking at kind of a spot where, those weren't good times, 1929, 2000. You even look at the kind of the peak there in 07, it didn't even get that high. It was at 25, which was still historically high, but it wasn't anything near what we were hitting now. So we've got a serious headwind in the markets in general. Now the Federal Reserve's doing everything it can to defray that and make sure the market's going to go up. It's not a mandate for the Federal Reserve to make sure the market goes up, but it certainly looks like that's how they're functioning. Anytime the market starts to pull back, they come in with tons of stimulus, and it has worked so far. But you have to start to say, are there short-term moves going to have a big-term impact? Who knows? But this is one of the four horsemen. This is a trend that is going to play out over the next 10 to 15 years. We're going to have serious headwinds for equities. The second horseman, and I've been talking about this really for a long time now. I've got clients I've had since early 2000s, and it was starting to really peak up at that point. In the early 2000s, we were already well over 200% debt to GDP. And this is a graph I've shown all the time. Again, this actual chart's it doesn't look real good, but it kind of gives you an idea of what was going on with our total debt. So this is individual debt, it's corporate debt, and it's government debt divided by the size of our economy. And you can kind of see we peaked up in 2008 at over 360%. So $3.60 of debt for every dollar of economic activity. Back at the peak of the Great Depression, it got to 3-to-1. So at the peak of 08, we were even higher than 1929 substantially. But we were basically, $3.6, $3.7 of debt for every dollar of economic activity. It's pulled back since then, but it's still over 300%. Well over 300%. It's like 340% debt to GDP right now. So that's been huge. And this gives you just U.S. government debt compared to GDP. And we're now broaching in the projection. This chart is actually 2 years old. It's 2018. And we got to 106% debt to GDP in 18. For comparison purposes, at the peak of World War II, we were at 118%. And that's when the entire economy was driven towards the war effort. So, even before all of this, we were pretty close to the peak of World War II. And now we're going to have a deficit this year that's easily going to eclipse $3 trillion, possibly up to $4 trillion. And again, put it in perspective, before the downturn, before GDP started shrinking, we were about a $18 trillion economy. So just a $4 trillion deficit compared to 18 trillion of the total economy, everything in the economy, that's substantial. And that's before the downturn. So obviously we're not going to be at 18 trillion of GDP. We might cut that back by 20% when this is all said and done. So you have a problem with government debt, but it's not just government debt, it's corporate debt as well. And this chart just kind of gives you an idea, the percentage of corporate debt relative to GDP. And again, we're at an all-time high. We have eclipsed the peak it set in 2008. So, and the thing is, this isn't like total debt. Like you say, okay, it's inflated. It may be the highest ever, but inflation's adjusted for that. No, this is relative to GDP. So as GDP is also growing, our debt is still exceeding the rate of GDP growth. This was kind of a cool graph I found. Again, this is about 2 years old. It gives you all the countries' government debt relative to their GDP. And you can see the bullseye in the middle is Japan's at 238% debt to GDP. It's just ridiculous. But you can see some of the other countries are up there too. Greece is at 182%. A lot of countries over 100%, many over 90%. Where you'd probably want to live is some of these countries on the outer tier there, the dark greens that are single digit. So, that maybe you want to make a move to the Solomon Islands or something along those lines, or even some of the ones that are really anything under 50% debt to GDP is a very healthy range. So you can kind of look at that, but it's a problem that a lot of major countries are having. And this just further indicates the debt problem, looking at everything from the Euro area, United Kingdom, Japan, US, and China. And you can kind of see at the 07, 09 era, that last downturn, you could see the ratio of this reverses. Instead of debt to GDP, it's GDP to debt. So now you can see where we pulled in at the end of Q1 2019, from 2017 to Q1 2019. Again, you can see that the numbers only were getting worse by a substantial amount, especially if you're looking at China. I mean, China, after the 07, 08 crash, they just went ballistic on their debt levels. So, I mean, it was just remarkable, the amount of debt they've taken on. But everybody, I mean, we did it as well. We increased our debt substantially, and so did all the other regions of the world. So why is debt a problem? Well, it's obvious in your personal life, you don't want to have a lot of debt. And if you do, usually those people are struggling financially. And it's really the same. If it's a problem for an individual, if you all of a sudden take it in aggregate and everybody has a debt problem, why should that be any different? I mean, how can people make an argument that at the individual level, debt's bad, but then at aggregate, it's completely fine? You really can't. And really, all of the economic studies show this. So if you think about debt as an individual, let's say you make $50,000 a year. So you have a lifestyle that you can afford at $50,000. Well, if you start taking on more debt, if you're doing credit card debt, you can all of a sudden live much better than a $50,000 per year income. You can do that for a long time. So that extra dollar of debt that you incur at first is going to give you a much better lifestyle. In fact, you're going to see what they call a multiplier, the debt multiplier. You're going to be able to go up and live a way high. If you take 30,000 debt, somebody making 50,000 is living like they're making 80. That's a much better lifestyle. But the problem is that continual debt, it builds up. Your payments go up. In the individual level, you look at credit card debt and they require you to pay back 2% of your balance every month. So when you're first taking on this debt, it isn't really a problem to make that 2% payment. But as that payment gets bigger and bigger, all of a sudden, that $80,000 lifestyle and that $50,000 income, you're pulling that $8,000 back just to be able to pay the debt. And then it gets to the point where even at that 50,000, that all of that debt you're taking on, you have to keep pulling it back further and further just to pay your interest cost on the debt. And then you even get to the point where your $50,000 salary is going to be shrinking. So now all of a sudden you're making $50,000, but you're only living a $40,000 lifestyle or a $30,000 lifestyle in order to handle the debt. It's a multiplier. So what this chart gives you an idea is what did we get as far as additional GDP growth or economic growth for the amount of debt we're taking on. So back in, after we came out of World War II, I always hate to hear people say that it was the war that got us out of the Depression. It wasn't. It came after the war. We were booming in the 50s and 60s. But the reality was we brought our debt levels way down. Even with the government spending 118% of GDP on the war effort, as soon as the war ended, they brought their debt level way down. I mean, substantially, like a 2/3 cut. But the other thing is, what were people doing during the war? They were saving. I mean, you didn't have a whole lot you could spend on for social stuff, but the savings rate was 25%. So people were saving a ton of money. So we came out of the Great Depression with a low debt to GDP ratio. And that really spurred everything. The other thing that helped America, obviously, was after the end of the war, we were the only game in town. I mean, we were the only production economy that was standing. Everybody else was basically trying to rebuild. So that also helps. If all your competitors go out of business, your business is going to do pretty good. So anyway, I kind of digress a little bit there, but the big thing is we had that tailwind from the World War II generation. So we got into the 50s and 60s, and really we had very little debt. They were still really taken back by the Great Depression. They didn't want to take on any debt. The government was acting more fiscally responsible. So we had a really good position. We were below 50% debt to GDP for the government, well below it. And then individuals were still saving at least double digits per year. So we had a really huge glut of savings. So in the 70s, when we started, in the late 60s and 70s, when Johnson started doing his, guns and butter approach, where he was funding the Vietnam War, as well as many social programs, and he was doing it with debt. Well, it had a pretty good impact, because at that time, for every dollar of debt we took, we were basically increasing our standard of living, if you will, by $1. And that even continued into the 80s. So it wasn't quite as effective. We were about 1 to 2. And then the 90s, 1 for 3. But now you can see for every dollar, for every $5.4 of debt we take on, we're only generating $1 of additional economic growth. So it's ironic that the more debt you end up taking on, the lower the actual impact that you're going to get as far as growth. And we're just at a point, I've shown you already, that the debt levels are so high. What we're doing is we're just using so much of our income just to service the debt. If you want a really good idea for some reading, I've recommended this to clients for years. It's called This Time is Different. And it's both of these professors, these PhDs, were at University of Maryland, and now I think one of them's moved on to Harvard and one's gone to Columbia or something like that, because they made a name for themselves. But this is a great book, looks at history, 8 centuries of, they call it financial folly, but it looks at the banking issues and crises for 800 years and what the big critical factors are. So if you don't want to take the time to read it, here's the 2 points that are sort of the no turning back point for countries. The first one is when your government debt gets to over 100% of your GDP. We're there. So we're easily there. And with this $4 trillion debt, we're probably going to be about 125, maybe more. You look at Japan, they're number 238. That's bad. But the second factor, and we're not actually here yet, is where 40% of your tax revenue is just going to pay your debt. We're not there yet. In fact, I think we're at 25%. So what they found is once countries got to these two figures, it was kind of a game over. There was just nothing that they could do. You started to see, you could see massive deflation as things just pulled back, or you end up getting where they doubled down, started printing money, and you had inflation. But in every situation when they've had that through the past 800 years, it basically resulted in some sort of reset. Okay, so now we know debt is one of the horsemen. Now we've got the third horseman, which is our unfunded liabilities in demographics. Okay, so if the debt problem's bad now, just wait. It's going to get a lot worse. As the baby boomers sort of move through the retirement period for themselves, what we're going to start to see is just a massive amount of required spending in order to satisfy the obligations we've taken on. This chart gives you kind of a quick idea looking at the government spending categories. The black line on there, if you can see the black line, that's our total tax receipts or income receipts for the government. Okay, so that's everything. That's everything we bring in. Social Security taxes, the sales taxes, the income taxes, any kind of tariff, everything coming into the ports, everything we charge there, all that stuff. Basically, bottom line, what are we bringing in? So you can already see we're at a bad spot that essentially everything we bring in is being spent. And this does not include interest payments. Okay, so this is just the spending on the programs. So you can already kind of see the growth that we're projecting over years for Social Security and Medicare. Those are the two biggies. And then you've got defense in there and then everything else. So we're already in a bad spot. And you can kind of see that the light blue line at the very top is our actual spending. Okay, so once we start to throw in the interest payments on all of this, you can start to see it's going to get out of hand here over the next few years. And by the time we get to 2030, 2040, it's really going to be a bad situation. And that's if rates kind of stay where they're at, if they stay low. Just to kind of give you another little look at the Social Security again, Social Security and Medicare, and just the interest. This again breaks it down in a little different way. Starting off at 2000, the year 2000, when we actually balanced the budget. Remember that? That seemed like decades ago. Since then, it's just been an upward climb of debt. But you can sort of see by the time we get to 2028, if you take Social Security, Medicare, Medicaid, and then our interest, that's essentially going to be about 16% of total GDP spending. And then our revenue is about 18.5%. So just those three things alone are going to take up the vast majority of our budget. And this was before all this happened, right? This was the Congressional Budget Office. I think this chart was done in 2018. So that was like 2 years ago. So we're probably looking at a much worse situation than that right now. And the big reason, again, is the boomers and the Gen Xers start to make their way through the retirement pipeline. And it used to be when they first started Social Security, really up until the 50s, maybe even in the 60s, you had up to 11 people paying in to Social Security for every recipient. And you can start to see from the 70s up until 2010, I mean, that number has been coming down. And it's projected by 2030, we're only going to have about 2.3 people in the workforce paying for a Social Security benefit. So, this is just something, it's a pay-as-you-go system. I mean, Social Security has always been a Ponzi scheme. Ponzi scheme is nothing more than the money that comes in then goes out to other people. And the reason that the Madoffs of the world got exposed is eventually when you had a downturn, the money coming in stopped, but the request for money coming out didn't. And that's what exposed them. So they're fine. And you run a Ponzi scheme for as long as you can until the amount being requested out exceeds that coming in. And Social Security, the thing is, it's not going to blow up like a Ponzi scheme. And the reason is you're always going to have some people paying in for this thing. You're always going to have that 2.3 per, people per recipient paying in. So there's going to be something there. It's just, how much is that going to be? And is it going to be as much as they've been saying they could pay us? And so if the Social Security and Medicare isn't bad enough for you, now we've got, let's throw on top of their public pensions. Okay, so if you start to get into the state pensions, state and local pensions, you've got another nightmare. This chart just gives you a quick idea of which states look the worst as far as having unfunded pension liabilities. So in the private sector, when they run a pension, they have to look at all of their projected spending through the end of life for all of their recipients. So when they're funding it every year, when the company makes their contribution to the pension, they have to incorporate all of that. Well, on the public side, in the government, they don't do that. They still have some numbers, but they aren't required like a private company to figure out what they have to do for all of their unfunded liabilities. So the government's basically sort of just kicking the can down the road. So you can see there's some states that are pretty well funded. I mean, if you're thinking that you want to live in a state that's not going to have to jack up your tax rates to pay for pensions, you might want to move to Tennessee, Indiana, Florida. Those states are looking pretty good. But if you're looking at Alaska, Kentucky's really bad. I mean, Illinois is just a nightmare. New Jersey, New York, they're all really bad. So this is going to be another problem that you're going to have. And right now, before this downturn, most of the state and local pensions, just to pay them, they've taken out about $2 trillion in debt. Now, $2 trillion, when you're talking at the federal level, that's nothing. But you have to remember basically the total income for the states. If you take all 50 states and you just look at their income, their tax base, it's about $7.2 trillion right now. So if you have already a debt of $2 trillion, that's pretty substantial. And then they're expecting that the debt is going to quintuple over the next decade. So you're going to have a lot of states that just can't function. They can't pay their debts. The pensions are going to be adjusted in some way, possibly. So Illinois really tried to get some money out of this last stimulus. I think they asked for $64 billion. I think that's the number. I'm not exactly sure. But a lot of it was, that obviously they're using the coronavirus, and there is more expenditures, less revenue for the states due to the virus. I get that. But they were asking for a lot, hoping to put in some of their cash to make the pensions a little bit better funded. So I think you're going to see a lot more of that they're going to try to come to the federal government. Now, I was happy. I don't know your positioning. I was happy McConnell said no. I just don't think it's fair that some of these states like Tennessee and Indiana and South Dakota that have very well-funded pensions, where they've been prudent with what they've promised their workers. Why should they have to pay for Illinois? Why should they come into the Chicago system that's just rife with, I think there's 8 million people making 100,000 or more on pensions in the Illinois. That's ridiculous to have that level of a pension. That's not how it's supposed to be. So why should those people have to pay for Illinois? Now, the question gets down to is, and this is the ultimate question, is the Fed just going to start printing money to pay for all this stuff for everybody? It's just anything that's any shortfall the Fed prints. And that's really something we'll get into kind of the next week. We'll address it a little bit here, but that's a choice. It's either going to be a default or restructuring, which is deflationary. So you get that sumo wrestler with the deflation, or you're going to just start to print the money. And that's going to be the inflationary part. So what's it going to be? What's the long-term going to be? Okay, so the last horseman. So far we've got an overvalued stock market that's probably going to have an impact over the next 15 years or so. You've got a huge debt load right now as it stands, which is only going to be furthered by the third horseman, which is going to be the demographics and the pensions. Those, and in fact, I didn't say this, but the total unfunded pensions, if you look at state pensions, if you look at Social Security, if you look at Medicare, all of that, there's been estimates by CBO that it's over $100 trillion. Think about that, $100 trillion. So you've got all of that. And then the fourth problem that I see right now that's a huge factor is the US dollar. So you would think with all the money that the Fed's been printing the past few years that, the dollar be getting just hammered, but it's not. And the reason it's not is because the US right now is the world's reserve currency. So what does that mean? It means that the world uses US dollars to transact business. So even if Brazil was going to sell some commodities to India for production, rather than those two countries figuring out a way to pay each other using each of the country's currencies, or using something like gold or silver or something that they've used in the past, they have to transact in dollars. So they've got to get US dollars in order to make that transaction. So if India is going to buy some commodities from Brazil, they have to get US dollars in their hand to give to Brazil. And then what happens is each country then turns that back into their own currency. So we've got a trend that's been going on. Despite what the Fed has been doing, the dollar is actually getting much stronger. So that can be good for you as an individual, because when you go into the grocery store or you go to the gas station, if the dollar is getting stronger relative to the rest of the world, you're going to pay less at the store or at the pump. That's great. Or if you travel internationally, you love when you have a strong dollar, because you go over there and your $1 might buy $1.20 of their goods and services wherever you're traveling. So on an individual level, it's not a bad thing. But on a longer term, sort of the macro environment, it has an enormous impact, and it's severely deflationary. Again, it's deflationary for you as an individual, because if you go into the stores, the gas pumps, all that, your prices are getting better. Now I think deflation is actually in many cases a good thing. You don't want a ton of deflation in the stock market because that affects your net worth. But in prices, that's a great thing. But the the dollar strengthening worldwide has a massive impact, a deflationary impact on the world. And not just here, as far as you go in the store or the gas pump, but also on foreign countries. So it's a big issue for the world. And this gives you kind of a trend. The dollar strength peaked in the mid 80s, and it's been really kind of on a downward trend since then. But that trend has been broken here the past 4 or 5 years. And it's probably only going to get worse. And the big reason it's going to get worse is we're having, obviously, an economic event that's going to take GDP for all countries down substantially. We're looking at a very deep recession. Again, we talked about this last week, but in 2008, we only saw about a 7% total decline in GDP, yet the market went down 56%. This is for pretty much every country. We're going to see more than 7% downturn in their economic activity. And already, even since the beginning of this year, if you look at different currencies, you can see that most currencies have already depreciated greatly relative to the US dollar. So why does that hurt these countries? Well, the big issue, again, we're transacting in dollars. So if they are now all of a sudden, we go back to that India and Brazil situation. So India wants to buy commodities from Brazil. Maybe it's foods, maybe it's oil, whatever. Well, before they've got to go and get US dollars to give those to Brazil. But if India's currency has depreciated relative to the US dollar, it's going to take a lot more of their currency to buy those US dollars. So all of a sudden, that's going to put a real crimp on them. right? They're not going to be able to buy as many goods and services from other countries because they can't afford to get as many dollars. The other thing and this is the more powerful part, is right now, the way it works is most countries have to get debt. So when they're doing government debt, they have to get it denominated in US dollars. Some countries don't. If they have, some countries with central banks can issue the debt in their own currency. So some countries in Europe, Great Britain, Japan, they issue their debt in their own currency. But if you're talking Indonesia, if you're talking many of the emerging markets, Brazil, Israel, India, a lot of these emerging markets, they have to get their debt in US dollars. So again, if they have debt that they're trying to pay back their debt and their currency depreciates relative to the US dollar, it takes more money to pay their old debt off. So it'd almost be like you having a mortgage that you're paying $1,500 a month on your mortgage, and all of a sudden the dollar depreciates, and you don't keep that $1,500 a month. Because your currency depreciated, now you're paying $1,800 a month for the same mortgage, or $1,900 a month. So again, now you can't buy as much goods and services. It's going to really be a deflationary effect on your economy overall, because you're spending so much more money on your debt. And as I showed you, debt is a huge problem for most countries. So if you have a large debt load already that you're servicing and your currency depreciates, now you've got a problem. You've got a huge problem. You're spending even more of your income on your debt load. So it's going to have a massive impact on the world. And this kind of just gives you an idea of longer term trend here. This is just a basket of Asian currencies relative to the dollar. And you can kind of see it dropped off on the far left, dropped like a rock when Japan really, took an economic downturn at the beginning of the 90s, but had been picking up since then. And then really since, 2013, 2014, we started to see a downward trend, but it's really breaking below again. So the Asian economies are going to have a problem if this continues. Now, emerging market currencies have always kind of been in a free fall. You can see this goes back to 2011. I mean, it's been a pretty steady decline for emerging market currencies for a long time, and it's really accelerating for them. So these emerging market countries, we've had issues in the late 90s when we basically bailed out Russia, and then they had the Asian currency crisis, the Thailand currency crisis. The Fed has been able to step in because those were sort of isolated events, weren't that big. But if we now have a situation where many of the emerging market countries are having this problem, it gets to be too big, and it gets to be a deflationary. You have a situation where they're going to have to restructure debt in some way, whether that means they just completely default and stop paying, whether it means they go and they start to renegotiate the debt. But either way, it's deflation. Somebody's going to take a haircut. So the bondholders who own their debt are going to take a haircut. The countries are going to take a haircut because they're spending more of their money on the debt load. So it's a huge deflationary environment. Now, the only good thing, right now there's about $12 trillion of foreign debt denominated in US dollars. Okay, so there's 12 trillion bucks that are kind of on the hook right now. Now, the only thing it's good and it's bad is many foreign countries also have a lot of our assets. They have a lot of our treasury bonds. They have a lot of our stock. They have our real estate, all of that. There's about $39 trillion of foreign ownership of US assets, which is huge. So there are some reserves for these countries. So if their 18 trillion of debt starts to go bad, they have some assets in many cases that they can tap. Now, is that good for us? What happens if foreign owners start selling our bonds? What if they start selling our stocks? What if they start selling our real estate? How does that impact us? Again, it's deflation. It's going to be deflationary. So the Federal Reserve has really fought hard. And right now, the past month, they've done a good job of keeping the foreign countries from selling US based assets and from so far any kind of default on their debt. What they've done is what they call swap lines. So these foreign countries were putting their assets, usually treasuries, as collateral to the Fed, and then the Fed would give them some clean cash in order to keep things copacetic. So the Fed so far has just tried to create a lender relationship. Now, there's a lot of people saying, is that actually authorized by law for the central bank, for the Federal Reserve Act? I don't think it is, but we're lending to foreign countries. That's not what the Fed was intended to do, but they're doing it to try to keep the debt from being defaulted on or having them have to sell US based assets. And how long can they do that for? It depends how long this downturn goes. So if this downturn is something that we V-shape it up, hey, it was probably a good move, even if it possibly was illegal. But what if it continues on? What if it goes for longer? What if it takes us longer to get back on track? And I've been saying the first, Coffee with Kirk I did was sort of, is this a snowstorm? Is it a typical winter, or are we looking at ice age? Well, we have some data already on the V-shape recovery. If you look in China, is it TomTom, I think, is a GPS. And what they do is they track by every city, you can see what the traffic is in these. So if you look at Shanghai, so China supposedly is kind of through this, right? And it never even hit Shanghai, it stayed in Wuhan. But if you look at the traffic patterns of Shanghai, during the rush hour traffic, they're back up to where they were before the virus. But if you look from after rush hour, so maybe say 10 a.m. to 4 p.m., non-rush hour, it's down about 90%. So rush hour is still big, non-rush hour, not so much. And then you look at the weekends. Weekend traffic is down 90%. So even though the economy is supposedly back open in China, you still have patterns by people that they're not going to go back to their normal lifestyle. It's happened in Singapore. They're down over 95% traffic. So a lot of these places that are starting to reopen, even you look at Italy and Spain, have started to creep back into being open, but traffic's not coming back there at all. So this has had an impact on people, and it's going to continue. The fear that people have of the virus is going to prevent people from taking trips, from going out, from socializing in certain aspects. It's going to have a big impact on the economy going forward. So, for those that think we're just going to pull back the 30 million people unemployed right away and things are rolling again, I don't see it. And between fiscal spending by the U.S. government and then the Fed pumping in money, I think for the short term they've done a good job of sort of filling the gap. But it's just, if that gap isn't a short-term gap, what happens? That's where the deflation argument comes in. And to give you kind of bottom line, how does it affect your wallet? This is a good chart showing the strength of the dollar relative to the stock market. So you can see once we started to have some problem and the dollar rapidly strengthened, that's also the point where the market rapidly declined. And then as the Fed and the U.S. government threw in some stimulus, you started to see it did pull the dollar back a little bit. So again, that's what you would think. If they're going to throw more dollars out there and create more dollars, we're certainly not going to be as strong on the dollar end. So almost to the T, when the dollar started to weaken, the market started to pick back up. We've had a nice little rally here. And this goes back, if you look at the 08-09 crisis, exact same thing. The moment the dollar peaked and started to weaken, the stock market bottomed and started to climb. Okay, so the reason I'm worried about the dollar continuing with its strength is because it does have a huge deflationary effect on the economies of the world and us. But it also has that deflation effect on your wallet because it does have a negative impact to stock prices. So this was back in the 2008 crisis, this was the Fed's balance sheet. So what's the Fed doing here? They are printing like mad. Okay. This chart I've shown before, if you go back even 2 or 3 decades, if we could take this back further than 07 and go all the way back to 67, you would see the Fed's balance sheet was pretty flat all those decades, all those years, at about $800 billion, and almost all of it was treasuries. And then this gives you an idea what they started to do in 08 into 09. So they took their balance sheet from 800 billion to over almost $4 trillion in just 2 years. Okay, so that was a 2-year period of that climb. And it's kind of stayed there for a long time. So this gives you a chart just this year, or really, I think back to March of 19. So we were at that $4 trillion mark. You look at that white line, it's that 4 trillion. And then March of 2020, look at that thing go. So we went from, roughly 4.2 trillion to 6.5 trillion in a month. So we had decades of 800 billion, like 3 or 4 decades of 800 billion. And it took 2 years to get to 4 trillion. And we stayed there for quite a long time. And then it took another month to go up at another 33%. It's crazy. So now we get the backstop of massive amount of debt, tons of unfunded liabilities coming up. And then we have a situation where the dollar is getting stronger. So is the Fed, what's it going to do? I kind of see the situation. They're going to keep printing. They're going to keep printing. They're going to try to keep anybody from feeling any kind of pain. They do not want deflation. They don't want the pensions to have to cut back because that's deflationary. They don't want the government to have to stop spending because that's deflationary. Everything like that is deflationary. The thing is, are they going to be, they obviously took a lot of action really quick here. Are they going to be able to keep it up though? It's sort of righting the ship right now, but that's a short-term move. Is it enough? And the one thing is, when they step in, stocks tend to do pretty well. I showed this chart last week, but it kind of shows you the quantitative easings that they did. Every time they announced it, you saw a jump in the market. And when that quantitative easing ended, you saw a drop in the market. And the last one that's not on this chart, but back in 18, if you remember 18, the stock market was down about 10%. And that's when the Fed was raising rates because you were starting to get money again on your bank accounts. And they were also selling assets off of their balance sheet. So we saw the market pull back. So if they continue with their printing, it could be a boom to the stock market, but is it going to fix the problems? And we'll talk more about that next week. But the big problem that they have comes back to the debt multiplier we've already talked about. They're sort of pushing on a string if they're trying to get the economy going, because there's a concept in economics called the velocity of money. And this is just how fast you get $1 in your hand from your pay, from your investments, whatever. You get that dollar, you spend that dollar, it's starting to move through the economy. So whoever you give that dollar to, then they spend that dollar. So you start to see where the velocity of money gets going. And the time when velocity slows down is if people are saving a lot of money, because if you get that dollar and you just save it, it's not getting into the economy, it's not rolling. Or if you have to take that dollar and spend it on debt repayment. So those two things have a huge impact on the velocity of money. And obviously, the faster the velocity of money, the more economic growth you can have. And you can start to see since 2010, this thing has been dropping kind of like a rock. And it's just getting to the point where we're really starting to see a bad situation for the velocity of money. This gives you a chart going back to the early 60s as far as the velocity of money. Now, typically normal, you want to see between maybe 1.5 and 2. That's pretty good. In the 90s, when the market was really going, people were making a ton of tech stocks. They were selling it, buying vacation homes and buying, nice cars and vacations and all that good stuff. And even when the home prices were going up in the early 2000s, people were pulling that money out and, taking out equity and buying that new boat and all that good stuff. So the velocity of money was quite high then. So you had a good economy. You had a good economic growth. But it's been dropping since then. And with excessive debt and a lot more to come, and you get to the point now where we have lower GDP growth, so lower economic growth because of what's happening. And then you have to say, have people changed their ways? We have, so many, I can't remember the exact number, but they said most people, 50% of people they don't have enough to cover a $500 short-term emergency. So are they going to change their behavior after this? I would hope that people would. In the Great Depression, they did. Right? I told you about how during World War II, they had a 25% savings rate. I would hope people would, but that's not good for the velocity of money. So if you take a situation where we're already spending a ton on debt, and then you throw on top of that a change in the behavior of the people to where they're actually starting to save or pay down debt quicker, you're going to have the economy not turning over dollars that quickly. So even if the Fed tries to push more and more dollars out, if it doesn't get in the economy, it doesn't roll through, it's really not going to have that big of an impact. But the other things that I kind of think, and this is sort of, these are just some things to think about. I'll address these more next week, but I think we have some longer term deflationary ranges for things. So this was just the stock market going back to the 1900s, early 1900s. And you can kind of see the range bound over these periods. And again, we're kind of at the top end of that range. Now, certainly we could go up. Nobody knows what's going to happen, but more than likely, if we revert to the mean, we're coming back. We're going to come back a little bit. And usually you don't just come back to the mean, the average, and go up from there. You overshoot. So this gives you kind of an idea for the Dow Jones Industrial Average, what we're looking at. If you take a really long-term average, the bottom that it would project would be about 6,000. But if it turned back up and started cranking away, you could get up to 40,000 on it. So, I mean, those are kind of the big ranges, but you can sort of see this is a deflationary. You're not going to probably get past that long-term range. So more than likely, we're looking at something that's deflationary over time. This is the Fed's fund rate. And this goes back into the 80s. And you just see we've been in a downward spiral with that. And are we going to break out of that? We haven't really come close to it so far. And the Fed is sort of locked in right now. There's nothing they can do. In fact, they start talking, are they going to go negative? Are we going to go to negative rates? The Fed's going to fight that like crazy. But, I mean, we're at zero. So, I don't know. The one thing that they don't control, the Fed controls the short-term interest rates, but they don't control longer term. And this chart kind of gives you the 10-year Treasury. Again, the trend going back to the mid-'80s. And I'm looking at it and I'm thinking that it might force the 10-year Treasury into negative territory. Just if it gets to the lower bound range here, we might be at negative 2% on a Treasury. And the market does that. That wouldn't be the Fed controlling it. That's going to be the market. So we could have that situation. And it doesn't seem that ludicrous. If you think that the economy contracting, we could actually see inflation go negative, especially with the velocity of money slowing down. So if we have actual negative CPI growth, inflation growth of negative 2-3%, then even with the current yield of 1%, as far as prices, you're getting a pretty decent return. You're getting a 3% net return when you factor in inflation. So if this downturn continues and we start to continue to see sort of a downward trend on the velocity of money and the cost of living, you could see rates go negative. Again, very deflationary. Commodity prices are breaking a long-term trend. And again, the commodity gets back to that CPI figure, that inflation figure. So if they start really coming down, we talked last week about oil and what it did, but it's not just oil that's having problems. Certainly some meat right now is going up, but that's because that's a natural supply demand issue because you're starting to see that a lot of processing plants are shutting down. But if you look at wheat, if you look at rice, if you look at industrial metals, so if aluminum, things like that, steel, those prices are just collapsing. So you do have a situation where commodities overall are dropping. Again, deflation. The Fed is literally pushing 1,000-pound rock up a hill, and they seem to be making some headway this past month, but can they keep that up? So what I'm looking for, again, I want to talk more about sort of the end results. I just want to lay the foundation this week. But I'm looking, this is the 2-year Treasury over the past year and a half. And it's kind of the past 3-4 weeks, it's sort of settled down and it's gotten into a tight range. But if it starts to break below that, that 0.2% on the Treasury, if we start to see that, we could see, again, I expect more deflationary issues at that point, strengthening of the dollar, decline of the markets, that kind of issue. This is the 5-year. It's done the same thing. Past 4 weeks, it's sort of just steadied. It's gotten very range bound. But what I'm looking for is the market going to start to get close to those negative rates, start to pull that back, which is enormously deflationary. Remember, the bond and stock market are always telling you a story, and it's like, who's telling the right story? And if you talk to most people, they're going to say the bond market. The bond market is so much bigger than the stock market. The stock market gets the press. It's the darling of the press. It's in the media, but it's a pittance compared to the size of the bond market. So you always want to see what's the bond market telling us. And most people say, well, the Fed controls the bond market. No, they don't. They only control the very, very short end, the amount of the interest rate that banks loan to each other. So they only control the overnight rates. They don't control the 2-year, 5, 10, 20, 30. Okay. So again, I think we have a battle between inflation and deflation. And it's going to be the big story for the next 10, 20 years, probably. And I think the whole Goldilocks scenario, less history is absolutely zero guide for the future. I think the Goldilocks just nicely go through some decent inflation, not too bad, excellent returns on stocks and bonds. I just don't see it. I can't imagine it. I think there's going to be a lot more volatility overall, but it's going to be a battle between deflation and inflation. So you're going to have, on the deflation side, is just the natural forces, the Four Horsemen. And then on the inflation side, you're going to have the Fed really doing everything they can to keep that from happening. And they have they have an unlimited printing press. Comes back to this slide, what I was talking about from last week. 2 weeks ago. If you look at how the banking system works, it tells you a lot about what the effect's going to be from the Fed. So you have two sides of the balance sheet for banks. You have assets, and then you have on the other side of the balance sheet their liabilities. And the difference between the assets and liabilities is the equity. Okay, same with you as an individual. You've got your assets, you have your debts, and then whatever is left between those two is what your net worth is, your equity. The banking system, again, is a fractional reserve banking. So when you take $1,000, you put it in the bank. Fractional reserves means they keep a fraction of your money in reserves, which is typically 10% right now. So they take $100 of your $1,000, throw it in the vault so that if you come in a week later to get some money, it's in the vault. The other $900 they lend out. So then they'll say, I get that $900. I take it to my bank. They take 90, put it in the vault. The other 810, they lend out. And it goes on and on and on until that initial $1,000 that you put in the bank has created $10,000 of credit. That is going into the economy. That stuff is getting in there. That has an impact. So and your deposit is a liability to the bank. It's on their liability side of the balance sheet. Now, they may take that liability and they use the reserves or the mortgages they lend out, all that, it becomes an asset as well. So in a perfect world, you give them $1,000, that's $1,000 liability. they have $1,000 of assets. Just make it very simple. That's how it would work. What the Fed has been doing, even with this last $2 trillion bump up that they've done in their balance sheet, it's never gotten to the liability side, the deposit side of the banks. It stays on the asset side. And what happens is the bank takes their assets, whether it's treasuries that they own. It could be back in 2008, they took bad mortgages. The Fed would take that as collateral. So the banks take their assets, give it to the Fed as collateral, and they get this fresh, clean cash, right? It's printed money. Now, it doesn't end up creating a lot of price inflation because it stays on the asset side of the balance sheet. So that bank might take it. They might just hold it as cash because they have a really bad balance sheet. They had mortgages that are going bad. So they gave those mortgages to the Fed, got the clean cash. Fed's got the collateral. They have the cash, and now they're a healthier bank. Or they take that cash and they invest it. And that's why we've seen stocks and bonds and real estate go up so fast because it's more money chasing the same amount of goods. So on the asset side, we've had inflation, more than we probably should have, but it's all stayed there. Now, the banks may have lended that money to hedge funds or private equity, something like that, but it always stayed on the asset side of the bank balance sheet. Now, the problem is, if we have all these unfunded liabilities for Social Security, for Medicare, for pensions, if they just, the federal deficit keeps going up because they're doing all these bailouts, that's money that's going to get to us. Okay, whether we get it through the Fed printing money to make sure our pension stays where it is, that we get our full Social Security, that we're able to pay for our medical expenses through Medicare, that's all of a sudden going to end up on the deposit side. We're going to get to the point where it's not the Fed going to the banks to do this, all their operations. They're going to just have to start funding the Treasury directly. That's where you get the problems. That's where the inflation comes. So that's where it goes into deposits. Now you have a lot more money chasing the same goods and services. So that's going to be the problem. So this is sort of the foundation of just sort of the bigger issues that I see. And then, I want to just talk a little bit about what are the investment dynamics. And again, nothing's going to be linear. It's not like, okay, well, you need to have assets that aren't going to be manipulated or inflated away, things like gold. Next week, I'm even going to talk about some of I've been reading tons on the cryptocurrencies. I kind of didn't really buy into them before, but I'm starting to think, well, it is a set amount of crypto, and it could be the eventual system if the Fed continues down their path. So we'll talk about things like that, but there's going to be lots of that sumo wrestling, right? You're going to have momentum both ways. You're going to have deflation. Fed's going to fight it to get the inflation going, and it's just going to be back and forth. And the question is, which one has the bigger trend? Now, the Four Horsemen that I showed you, those are huge deflationary trends that are going to be there for a while. But it's, who knows? Who knows? But the Fed is going to fight this thing with everything it's got. And the question then becomes, is it going to get out of hand? Are they going to lose control a little bit? So I try to keep these an hour, just run a little bit over. So any questions, if you have any of those? Okay, so let's see. Are we paying our debt or only servicing it? Yeah, we're only servicing it. Yeah, we'll never pay off the debt. It's impossible. It's mathematical, and it's not just a political leaning on my end. It's math. I mean, there's just no way, because they would have to tax us to a level that would just destroy the economy, or they print it. I mean, they're going to try to inflate it away, but they're still never going to have enough to pay off the debt. It's always just going to be, can we service it? Another question, if we only had time to watch one indicator on the entire world because of our reserve status. Once we're not the reserve status, no, it wouldn't be that. But until then, I would look at the dollar. That's going to be the big thing. And I'm also looking at the treasuries, because I think if the treasuries start to pull back again, break below the sideways trend, that's not going to be good either. That's a clear deflationary event. Question, aren't cryptocurrencies the ultimate fiat? Yeah, possibly. Yeah. And we'll talk about that. So, we still, gold, cryptocurrencies, things that have a finite amount that can't be manipulated, that can't be printed away. That is, that's the ultimate. Yeah. And I wouldn't call it fiat, because fiat by definition means it's not backed by anything. That's what we have right now. We have a dollar. It's not backed by anything. That's a fiat currency. So you could just say, are cryptos or gold, silver, things like that, are they the ultimate currency? Yeah. You want to have something that you can't inflate it away. And we talked about that with the 2 weeks ago with the Fed. The problem when we got rid of the Fed or the central bank in our history is we let all the local banks create their own money, which created a problem. And then even the second time, we had 2 iterations before we brought on the Federal Reserve. We had another one where we said, all right, well, no more local banks doing it. We're going to have the national banks do it. And it's going to be backed by gold, but they still end up printing too much. And it caused problems. So, yeah, I think the end game is what's going to be our currency. What are our grandkids, maybe even my kids, what are they going to be transacting in? That's going to be the biggest question. Is it going to change? So in cryptos, you can make an argument. Kids are already online. It's not going to be that big of a deal for us. I know a lot of people that still like to have their little change pocket. They open up and pull their change out. It's a different world, but so we'll try to get a feel for what's the ultimate. So let's see, is there any other question? Doesn't look like there's any question. This is a lot of stuff. This is pretty heavy duty stuff. I just want to try to give you sort of the 4 big trends that are going to have an impact. It's on the economy going forward, and then we'll try to pull that into what's the end game, what's the investment look like going forward. So again, have a great weekend. I appreciate you coming in. Any questions or any topics you'd like me to talk about, you shoot them my way. I'd be happy to. If I don't have all the information, I'll try to do a little research for it. If I think it applies to quite a few clients, and all I'm trying to do here is answer a lot of questions that clients have and address that kind of at a bigger scale, because I know a lot of clients have the same questions. So have a great weekend, everybody.